This session is about transition, about ambition, about entities. I know you've been talking out there about what needs to be done, how much needs to be done, and the extraordinary opportunity we have to ensure capital flows to the right places to drive the necessarily ambitious transition. No time for soft measures, please. We now need serious, substantial ambition if we are to achieve our 2030 targets. No 5% measures, please. Give us 50% measures, and so on. Well, at least that's my line. You're going to find out. My job is simply to first announce that our chemicals criteria are launched today. That is, certification for bonds in the chemical industry are now eligible in the climate bonds criteria. Look online for that. This is the formal announcement of those criteria. We expect to have some certified climate bonds in that sector. And my second job is to introduce the moderator for this session, Zaluna Shamshuddin, who's our head of Asia Pacific Climate Bonds Initiative. Zalina, over to you.
Thank you, Sean. Hi, good morning, everyone. Thank you for joining us. I think the key theme of this session is primarily going to be anchored around net zero ambitions. I think that's been the key word this year, or in the last 12 months at least. You've seen countries commit to net zero ambitions. You've seen large PLCs commit. You've seen banks commit to net zero ambitions. But fundamentally, what does that mean? So that means that we're shifting away from having to just finance green. We now need to also finance into green. So the theme here is transition finance. And the financial sector has responded well to this. So we have different types of theme bonds now. We have SLBs, we have transition bonds. So the financial instruments are there, and we've seen significant sort of uptake of that. But the issue is that the fundamental issue, the chatter lately has been around the credibility, around how effective or how ambitious are these financing instruments, how ambitious are the transition strategies of issuers, and what is the role of investors in pushing this agenda. Based on that background theme, I'd like to introduce my lovely panel today. We have GFANZ, Green Building Council. We have an intermediary, Credit Suisse, and then we have an investor. All the pressures on Rupert at the moment, State Street. And so without much ado, let me start off by kicking off with Tony. Hi, Tony.
Hi.
If you could just introduce yourself and just tell us about how GFANZ is helping in the is helping in the transition space.
Thank you, Zelina. Hi, I'm Tony Rook. I'm Executive Director at GFANZ, the Glasgow Financial Alliance for Net Zero. We are an organisation that draws from and works with sector-specific alliances across the financial sector. And we're really there to support those financial institutions in actualising their net zero commitments, providing the pan-sector view, but also guidance and tools for them to help them in their net zero commitments and turning that into transition plans. And our work really covers implementing those commitments, scaling and accelerating finance into emerging markets and developing economies, engaging with policymakers to support, to provide a regulatory market that supports net zero, and creation of a public data utility around transition information, particularly around targets and greenhouse gas information. And really, at the heart of what we're trying to do is help financial institutions to understand, what does a transition plan involve? It needs to be an action plan, as well as setting goals and governance and accountability. And really turning that into, what does that mean in terms of what it finances? And giving the transition finance a definition, really, which is about, how do we finance and enable and scale climate solutions to help us decarbonise? How do we also support those companies that are aligning or aligned to a 1.5 degree pathway and net zero? And finally, also, how do we scale finance to manage a phase out of high emitting assets that cannot be decarbonised? So that's the broad brush of what GFANZ does, and transition finance is at the heart of what we're trying to define and work with financial institutions to do.
Great, thank you, Tony. So financial institutions now have a transition plan and the tools to help them transition. I'd like to bring Christina into the conversation. Christina, you represent the Green Building Council, which fundamentally represents one of the largest real economy sectors that contribute to GHG emissions up to 20 to 30% across the world. So in terms of the issuer space, how does the council support issuers to meet the need for credible fundraising?
Yes, thank you so much. Yes, so the World Green Building Council represents over 75 green building councils in different geographies. The built environment represents around the world 10% of GDP, and as you said, it's a little bit more of energy related from the use of energy, the demand side. The built environment can represent up to 38% of global greenhouse gas emissions across the full life cycle of buildings. So what are we doing about it? I think our network has been working for many years to make sure that the world changes the way they build, specify, operate, and disclose information of what is a good asset class for the building sector. And I guess for many years, green building councils have been setting, let's say, the foundations for what is now in the built assets, the foundations for ESG reporting. And what are we doing? We are aligning toward progressive goals, towards, of course, science-based scenarios, and the network has been setting out a set of tools for advancing net zero. We have a program that's called the Net Zero Carbon Buildings Commitment that has front runners in that race to zero from the UN high-level climate champions, almost 200 companies and cities in collaboration with a lot of entities to create a demand signal for a better quality infrastructure. And of course, that goes to creating the sorts of indicators that we still have to make an effort to have a better conversation with the financial industry to give certainty that this can be done, and to scale up the finance that goes into better assets, because what we desperately need is that we avoid more resources going into bad buildings and make sure that the world gets at least the highest energy efficiency, which is the golden rule to start on the pathway in this sector for net zero, disclosure, and a lot of collaboration with policymakers.
Thank you, Christina. So engaging with financiers, shifting demand from bad investments into the better green investments. On that note, Scott, as Credit Suisse, an intermediary that is the face of the pipeline of issuers that come to the market, how do you ensure that the issuers that come to market provide credible transition plans that asset owners and asset managers and investors generally can look at and consider as viable investment products?
Yeah, it's a great discussion, and maybe for background too, I spent about 8 years in Europe. I ran capital markets for Credit Suisse, and currently in my role, I'm global head of the financing team, so we see deals in Asia, Europe, Switzerland, the US, and I could tell you, spending a lot of time in Europe firstly, and the pathway for companies in transitioning, and I think about the large integrated oil and gas names, bigger metals and mining companies of really several years ago getting on a path of saying we need to do something about this because capital flows or lack thereof will dictate viability as I think about the long term. I'm thinking about 2030 and 2050 with net zero. So firstly, as far as credible transition, I think and we're seeing this quite actively, is a real deployment or redeployment of capital into clean tech. And I a couple examples of this week. There's been BP invested in equity stake $4.1 billion in a Swedish green hydrogen effort there. There's a number of steel companies that are again investing in green hydrogen. So I think it's part of understanding there's energy independence that we all appreciate that needs, but we have to have real physical asset transformation not just a masking of, of really where the business is going to go. And there's going to be a fundamental shift. And obviously, we all agree that, and I think Sean probably said this well, that, natural gas is viewed as a transition, but we need to really make that jump, again, to real clean energy. So that's the first thing I'd say. The other thing is that I'm really, really happy that there's finally starting to be, global transparency disclosure of what is appropriate and green. And that means the financing that we're doing for all these companies, making sure that they're appropriately assessed, that they're selecting, KPIs, targets that are, again, material, ambitious, they're ambitious versus their peer group, and these are things that will hold, again, call it the companies accountable, but also on the investor side, which I'm sure State Street is going to talk about, of making sure that, that everybody is going to adhere to the policies in which they're focused on. So I'm very happy that, call it asset transformation is underway. We have a lot more to do. And actually, the good news now is I think I can start to see this quite actively firsthand in the U.S. in particular. Similarly, we saw it with obviously the Biden administration with the IRA, which was mentioned before, which is the Inflation Reduction Act. And that, I think, is a really important step. $375 billion of deployed capital for tax incentives, for carbon capture, for hydrogen, and a number of other clean tech operations, which make it a viable investment day one, so that people can actually move forward with that required infrastructure to get where we need to be, and again, net zero down the road.
Okay, thank you, Scott. Rupert, asset manager in the room. I must apologize. I was supposed to tell everyone to introduce themselves, which I didn't, but they were kind enough to do it for me. So Rupert, please introduce yourself, and please tell us what is your view of the state of the market in terms of sustainable finance and investments.
Thank you. Good morning, everyone. My name is Rupert Cadbury. I work for State Street Global Advisors. So State Street is a $4 trillion indexing manager, so one of the largest indexing managers in the world. Typically, the clients are institutional clients, and they have very much benchmark-focused risk-return objectives. Now, my role within that is I'm the fixed income strategist. I work primarily with the fixed income investors to incorporate ESG into their portfolios. Now, the institutional client base that we have is primarily benchmark orientated. When I say benchmarks, I'm thinking of like your Bloomberg Corporate Bond Index or your JP Morgan Sovereign Bond Index. They set the risk-return profile that those institutional clients need to have. It may be a pension fund that needs to target a certain risk-return profile. Hence, benchmarks are set, the first eligible opportunity set. What we were seeing, and it really started over 20 years ago, incorporating ESG with negative screening, but certainly over the last 5 years, recognizing that negative screening alone is not going to be sufficient to really facilitate the transition of some of those companies most needing that finance to meet the goals of the Paris Accord, certainly. So green bonds are increasingly a key element for investors. They're nothing new. They've been around now for over 15 years, but we're seeing more and more investors seeking to invest in green bonds as part of their investment portfolio. Maybe 2%, 5%, some even have over 20% investment targets. Now, the challenge is that green bonds are still a relatively small part of your fixed income market. They represent around 1% of your global ag. There's no eligible green bonds currently in an emerging market sovereign bond index, and they're a relatively small part in your emerging market corporate bond index. So we see huge demand, but very, very little supply, but certainly growing interest in committing to investing in green bonds. Now, key for identifying what qualifies as green is data. We use a large number of different data sources to identify not just what qualifies as a green bond, but also to what extent those companies or bond issuers, sovereign bond issuers, are meeting various ESG and climate-related objectives. And we integrate those into the portfolio design and construction.
Oh, sorry. So essentially, we've heard all the buzzwords. So quality of disclosures, data, ambitious plans, and stuff like that. But fundamentally, there's still a gap between the demand and the supply. I think one of the primary issues in this space of sustainable finance is the pipeline of potential issuers is still a lot smaller than the demand that's out there. So, Christina, could you tell me from your point of view, what do you think is the financing needs from the green building or the building environment And why do you think there's a gap between the pipeline of potential issuers and the demand that's out there?
Yes, thank you so much. So the financing gap is huge. The world is still urbanizing at a very high rate. One of the asset classes, and actually the biggest asset class around the world, is infrastructure, right? And around what is going to be built in the next few years, it's a great opportunity to avoid locking in energy, carbon-intensive infrastructure. If it's not done properly today, we will be locking in a carbon-intensive future. There's no Paris Agreement without the infrastructure sector. And that means there's the challenges is to channeling that money and the solutions for emerging markets. I guess those are one solution that can be scaled up properly. And I guess following, let's say, the collaborations and the people we have here in the panel, it's going to take building trust and confidence and scaling up those frameworks that we have right now in the alignment in the certification schemes, as we have done, for example, in Europe, to bring transparency on how this rating schemes can be useful for the EU taxonomy or other initiatives in collaboration with climate bonds, in order to channel more attention to the urgency of decarbonizing those portfolios. Because there's, of course, you all know this, there's several types of risks of bad infrastructure. So there's, of course, the physical risks that are being, of course, compounded by all the climate change impacts, but of course also the reputational and market risks of those assets not performing to net zero in the next few years. And that for any let's say companies that are committing to a net zero pathway, if these assets are not being addressed, there is going to be, let's say, a proper non-compliance with the goals. Needs transparency, mandatory disclosure of performance, understanding whole life carbon performance from infrastructure assets from the financial community. It'll take those data sets to be transparent so it can be properly understood and specified. It exists. The data revolution happened in COVID. The building management systems do have those sorts of data sets, and you can make sure that your financial assets invested in this way are performing as you've mandated. Second, of course, we have the different sorts of ways to deal with that risk in a way to deliver social value in the built environment, and the collaboration in channeling those funds in higher performance assets will, of course, help both capital, but also the people that need that shelter and those solutions. Yeah, I think if you know the numbers, the numbers are outstanding in terms of the volume of the opportunity. After energy, green bonds have been going also to the built environment, but it's not up to par to what is being built in substandard quality of what is needed from a performance side and carbon perspective and sustainability perspective, and it's and the opportunity also for portfolios to perform better in assets that will withstand better those risks and will have a better premium in terms of rental, in terms of their value in their long term, in terms of, we heard about the hostels in Kenya this morning. There is a health aspect to people's well-being in those sorts of assets, and we as a human race need that shelter and those buildings and that infrastructure to protect us and to withstand also and contribute to the climate quest.
Okay, thank you, Christina. I think that's a fair point. And as Sean mentioned, that I head Asia Pacific, and which fundamentally includes most of the emerging markets. And for this transition to be effective and for all of us to meet these net zero targets, we need to get the emerging markets into the discussion too. We need to provide the fund flows into them. But based on my experience, you talk about standards, you talk about disclosures, you talk about criteria, but there seems to be, where's the relation to the real economy? And on that basis, I find sometimes with my work, when I talk to issuers, and issuers especially, there's that disconnect to the real economy. So that's a great segue for you, Tony, because I know GFANS is looking at how to sort of interrelate this to the real economy.
Yeah, so I think, just generally speaking, I think this is the greatest opportunity of our lifespan. This is, I joined GFANS, and not to trivialize it, because this is the nearest I'll get to being a Marvel or a DC superhero. And I said both just in case you're a Marvel fan or a DC fan, and there are tensions between the two. But this is the opportunity for us, and it's the opportunity for finance to actually get out of the sort of bashing that it receives in the media as well, as being only lining its own pockets and not really concerned about it. This is an opportunity to do good. So hopefully I've made you feel good in your seats. Now the problem is that we need scale, and it's nuanced. It's not like you can actually apply it across the board. It needs sequencing. We need climate solutions in place before we actually be able to decarbonize and manage phase out. We need blended finance. So that we need public policy, public finance, multilateral development banks, and private finance all working together and not competing as well on this. And we need, as I said, we need scale. So if we look at the energy sector, for example, one of the tools that we have at our disposal here is being able to actually go, what are my targets in the energy sector? What do I need to do? Well, the scale that we have is currently for about every 90 cents invested in climate solutions, there's $1 invested in fossil fuels. That ratio of transition finance, of climate solutions to fossil fuel finance, needs to go to about 4 to 1 on average over this decade. So that's a critical component. There's something really tangible that you can start getting your teeth into. But there's also other things as well. Aviation, we need to scale the currently 50 SAF producing plants, sustainable aviation fuel plants, that are in the pipeline, to about 300 to 400 actually working and operating by 2030. So we've got 50 now. We need to at least six-fold that. I say 50 in the pipeline. That's another example of where we can use pathways to actually highlight what is the scale of the challenge and what is the opportunity as well. And then we've had this also for steel as well. We need 70 green steel plants by 2030. What's missing from all of this is you also need to create the demand. So I think a challenge for financial services and financial institutions is breaking out of the silo of going, what do I need in this sector? To actually thinking, well, how can I work across sector, across portfolio, so that one incentivizes another. So for example, the construction and infrastructure industry is responsible for 50% of steel consumption. Well, actually, the green steel production can get off the ground if they know that they've got guaranteed offtakes. So by working with clients in construction and infrastructure, in automobiles, in manufacturing that uses steel, you can actually coordinate. And therefore, there is guarantee, and it de-risks the investment in green steel. Mm-hmm. So there is a way of actually working across this. And if you think this sounds a bit far-fetched, but we know in private equity, there's a reason why there's less drilling going on in oil and gas. And it's because private equity are holding a number of oil and gas firms, and they're actually saying, well, actually, we don't want you to drill more because we want to maintain the profitability across all of our oil and gas companies. So this sort of coordination can happen. And I think that's the sort of way to realize this opportunity, is to think in a system way as well as in a sector way. So use the pathways to go, what are my targets in that sector? But what are the levers I can pull across my portfolio with my clients to generate the demand as well as the supply? And then finally, work with policymakers to make sure the environment helps. And Scott mentioned a great one with the IRA, which as a British person is also quite difficult to say and say that's the IRA is great. There's also the Repower EU, which is a massive sort of, that potentially within the EU puts that ratio of 26 to 1, climate solutions to fossil fuel. Even in this country, we have done well in terms of decarbonising our energy supply, but we need to go further. So I'll just leave it there because I can go on for hours, as you can tell. I'm really enthusiastic about it.
Thanks, Tony. Scott, I want to bring you in on this point that Tony said, generate demand and enable supply. And that is something Credit Suisse can do. Could you share with us in terms of what is Credit Suisse's transition plan in this space and how are you enabling this?
Yeah, I think there's two things. I think that there's been a great sea change in the way that the financial community, I'm thinking all the major investment banks globally, about committing to net zero firstly. Secondly, having sustainability targets, i.e. SBTI targets. And that net zero pathway dictates the way in which we communicate, finance, and deal with our corporate clients. And that could be anything from a clean tech company all the way to a high emitting company. And I'm a big believer that every firm needs to think about not only the return on capital that obviously it's deploying with its own balance sheet, but also about the carbon attractability or the carbon value of that relationship, right? Because you got to think about and Credit Suisse, by the way, on that same point, is and has committed and will have SBTI targets here. So we have a net zero pathway. That means that we have to be scrutinizing, obviously, the companies which you need to work with. We need to ensure that they're decarbonizing at a quick pace. We actually put a framework together, which I think we're one of the first banks to do it. It's called the climate. Basically, it's a client transitionary framework. Thinking about coal, obviously it needs to be by, let's say, 2030 down to less than 5%, or we're not going to be working with those specific clients. So I think all of that's coming. I think there is a couple other initiatives going on with PCAF, which is the Partnership for Accounting for Financial Institutions, and it's not just the lending commitment, but it's also the financing that we're doing. So equity underwriting, bond underwriting, and everything else, of tracking that to ensure that, again, it's a lower carbon footprint. So I think there's plenty of capital, and the banks are trying to push that. That would be number one. And then secondly, how we're enabling it. So just to give you a couple quick stats. So, and Sean knows this, and it's going to be different, but when we look at corporate bonds and lending, globally, over the last couple of years, it's grown exponentially. So in 2020, we were about 250 billion. Last year, more so than a year ago, we were about, call it 500 billion, and now this last year, about 1.1 trillion. And this year has obviously been a very difficult capital markets year globally, obviously, with recession concerns. But we are on track to hit what we did last year. And I think the whole purpose of this is how do we get to 5 trillion, which is the real bit. So we need a lot more, obviously, capital being raised by clients in green bonds and sustainability-linked bonds. And I do feel very comfortable that with the adoption, and I don't want to reiterate the points, but with the SEC, the Securities Exchange Commission in the U.S., requiring disclosure for both private and public companies coming to fruition in 2023, global ISSB standards. So you guys are probably familiar with ISSB. That's obviously a great step. And then when that happens, all these companies are going to have targets, have the ability and disclosure to then go to the markets like sustainability bonds, sustainability loans. It's just going to be a natural extension. And the other thing is the investor side is going to require it. It's going to be required. And so therefore, it's going to be net diversity centric in the sense of broadening out the investor base that companies can have access to. Number two, there's going to be a cost of capital benefit ultimately that will be shown out. That has been the case. Waivers over time depending on region. And I think thirdly, I think it's just going to then fulfill itself, and then this is going to accelerate again, hopefully towards that 5 trillion in 2025. And I'm very bullish on that goal.
Okay, thank you, Scott. On that note about enable natural extension into sustainable finance, transition finance, and hit that 5 trillion goal. At the end of the day, Rupert, I've been in finance for 10 years. And no matter what everyone says, the policymakers, the regulators, the intermediaries, the standard setters, everyone tends to look at the asset owner. So the pressure's on you. So in terms, if I were to ask you in the sense that how do we increase the demand? How do we build up that 5 trillion target from an asset owner point of view, as work is concurrently being done to build up the pipeline of issuers? What do you see from an asset owner point of view?
Definitely, thank you. So asset owners definitely recognize that climate is the number one risk, without a doubt. The key issue is transparency, as we've had a number of times on this panel, and also you'll hear it, I'm sure, throughout the day. Transparency, and for transparency we need data, and data needs to be standardized, frequently updated as well. So with that, it'll enable asset owners to identify which companies are making a transition, which ones maybe are not. Maybe they are taking steps but they're not recognized by asset owners. What are the steps they need, for example, to issue a credible green bond? Hence, for us and many of our asset owners, they'll only recognize green bonds if they meet the standards of the Climate Bonds Initiative. So having a clear, transparent standard. Also, one of the big challenges, particularly for institutional investors, is being benchmark orientated for that risk return objective, and the lack of bonds that actually qualify for inclusion in those benchmarks. So those projects which need that green financing, the hydro plants, for example, in Chile, etc., if governments and official institutions could take steps to maybe aggregate those projects that give a similar risk return and a scale that qualifies for standard benchmark inclusion, then you'll see much, much greater inflows by institutional investors into those green projects. But also those projects need to have regular reporting, impact reporting, so that those institutional investors can see what is the measurable added impact from an environmental and social and governance perspective is crucial as well. But for that, it also needs to be standardized, because these institutional investors, they're investing in hundreds, if not thousands, of green bonds, and they need to be able to see what the positive impact is on a regular basis.
Thank you, Rupert. I think before I open questions to the floor, I want to ask one final question in the sense that this is how much the private sector has done. These are the things that the private sector has to put in place to mobilize sustainable finance. But I think the key question that I'd like to ask any of you, and feel free to start the ball rolling, what do you think policymakers and regulators need to do more besides what it's being done now? Yes.
To start. I mean, some of them have already started. I think clear, consistent picture of what the regulation is going to be in the future and not sort of chop and change is obviously fundamental. Scott mentioned it and I re-mentioned it, almost like a retweet live on a panel. The IRA, the Repower EU, those policy statements and those serious amounts of investment money that's going in are really helping to shape what can be done. And Scott said it himself, to actually get the viability of investments. But there is a lot more that needs to be done. We need mandatory disclosure to get the transparency on exactly what data is out there and how good it is. We also probably need policymakers to actually lean in and not pick the solutions that are going to win, but create the right market environment so that we can get some of these proof of concepts or beyond proof of concept work together. So, for example, creating hubs around ports like Rotterdam, like in Hull, just to mention two in this country. Those can really help bring some of that infrastructure together so that instead of actually funding a project where you've got to create 7 things in a row, you've already got some of that infrastructure there. So you're actually only going, now to make this climate solution, there's only 2 more things I need to add. I think also to support the risk appetite is a really fundamental thing. We're talking about building new stuff. Some of it hasn't been done at commercial scale. So we need policymakers to also help us as financial institutions understand and reduce that risk appetite so that we can take that opportunity. That is fundamental, and I think that is globally.
Okay.
I'll stop there.
Okay. Christina, carrot or stick?
Carrot and sticks. Well, yeah, well, actually, the policies just in the US is a very good example of carrots and sticks. It has a lot of incentives to move industry because just sticks hasn't done it. In the real estate sector, there's a lot of regulation, and it should be, right? A lot, because it's around human safety where we use the spaces, and regulation has been trickling. But however, when there's mandatory things and shifts, Then there's the follow-up, the compliance. It just kind of sometimes doesn't happen. So the incentives are very important, but it's also, it has to be creative incentives, right? Because it cannot be just costing money to the Treasury. There can be performance incentives. What Scott was saying, we cannot delay governments. The governments could do today mandatory disclosure of carbon impacts and build up the data sets for that transparency, greater understanding of performance of assets, leading by example, by greening their own buildings and their portfolios and creating those markets by doing those policies.
But it's forward-looking metrics as well as backward. Like emissions is tending to be backward-looking. It's forward-looking as well.
Totally. And in the forward, if they don't put strategies for the forward-looking in the emerging markets, the new builds, that's super carbon intensive if there's no collaboration in bringing the power of finance to structure better solutions. And then the backward-looking, Europe is, I'm from Colombia, and what I'm seeing in Europe is a lack of vision of investing in improving the energy efficiency of real estate.
Yeah.
And then you have energy poverty in the 21st century. And it's really, there has to be a better understanding of government seeing the right, that the private sector is ready, that they can do better. But the policy signals have to enable not only the leaders, but the laggards. And then I think incentives.
Yep.
I'm going to take it just slightly different because I think one is, just briefly from a governmental standpoint, we have obviously a lot of work done with EU, with the EU taxonomy, the UK. There's nothing in the US yet, so I think there needs to be that to come online in due course. I think we've had a lot of great first steps with regard to global tax incentives that are going to get people to put money where their mouth is and have the infrastructure in place to build a better future. But I think the other bit is ensuring, as I think about the green bond market, the private markets, to have accountability about what is greenwashing and not greenwashing. It's a really important point. I wanted to make that because the devil is in the detail on these things, particularly when you're seeing loans or bonds that have embedded KPIs determining, ensuring that for that given sector, it's perfectly material and appropriate, and it's tracking the entire Scope 1, Scope 2, and Scope 3, so the entire carbon footprint. That's one. And then two is that I think that fortunately, there's going to be a lot of global peer, called peer pressure, where those capital flows will go to the company that's best in class within their given space. And I do believe that will happen. But I worry that because the market is growing so quickly, we have to uphold a very high standard. So as a private bank or as a bank, as an investor, as a policyholder, regulator, there's lots of policyholders out there, that there's accountability about what is getting done, and it's appropriate to sustain the long-term market and its growth, because that $5 trillion is needed. And if we have obviously deals that are inappropriate or detract from what we're trying to do, then that's not helpful. I just want to make that point.
Yeah, I just one thing to add to the discussion here, and apologies, I keep jumping in because I got used to chatting to the fellow panelists beforehand. So just while we carry on talking. One of the other things that policymakers need to really do is also create the incentives for the supply chain for all of this stuff. Because we can't build the infrastructure if we don't. We talk a lot about decarbonising, getting rid of high-emitting assets, but we can't actually build the climate solutions as well unless we have a more diversified supply chain. So if we take, for example, solar panels, everybody thinks, oh, let's invest in solar panels, that will solve it. But we need the grids behind it. We need the infrastructure. We need the suppliers for that. And we need those suppliers to be working in country, not just, at the moment, if you look at that, polysilicates, 60 to 70% of polysilicates are manufactured in one country. So it helps with the risk appetite if we diversify that supply chain as well, because then you're not reconcentrating the risk from one type of risk appetite to another. So I just that's a really sort of nuanced thing. And I have a favorite cartoon that shows a line of people going towards two signs. It says science versus everything else is the headline, and the two signs say simple but wrong and complicated but right, and those that most of them pick the simple but wrong and fall off a cliff. And the people that pick the complicated and right go to the, forgive my channeling of Boris Johnson here, but to the sunlit uplands. That's, I think, the sort of grown-up discussion that we need to have with policymakers. It is complicated, but there are things that they can do to help us supply chain, create the demand, the infrastructure.
And I'm going to jump in, because in terms of that supply, right, I think what I maybe bringing clarity to the message I want to bring also is that, yes, we need to build that supply and the clean energy supply and finance that transition. But if the thinking is just more of that, more and more energy, more and more clean, without thinking we need to reduce demand for energy, which is what the built environment should be doing, there's not going to be enough energy in the world for the urbanization that's going to happen. So when we talk green buildings, we're talking about the most high efficient possible buildings that can help the net zero transition. So we need to be thinking about reducing demand, and finance should be enabling those vehicles to enable that reduction of demand. And today we're sensitive to that because we're living in an energy crisis, and we have to not waste this crisis. And that understanding should fuel innovation in those vehicles, because there's not going to be enough. And the energy that goes into all the materials that go into the built environment, 50% of all the materials produced annually go into the built environment. Cities growing without keeping this in check, there's not going to be enough resource to keep us on the goal. So yes, let's do that. The clean energy transition, deliver on those networks, but there has to be an understanding that energy efficiency and demand can happen now. There's no barrier to it in that innovation.
And governments can provide the procurement of those materials.
Instead of paying, for energy bills, why not a package to promote energy efficiency across the geographies that need it?
Yeah. Just going to add, actually, to Scott's point around standards. One of the key things we need, that institutional investors need, is to have a global standard of what's recognised green. So it's great that the EU building their own taxonomy, UK, China, but these investors, they're typically global in nature and their exposures. So we need a global, credible standard to what qualifies as green. So that is absolutely key. The second point around accountability and bonds with embedded KPIs, namely, I think referring to sustainability-linked bonds. This is a growing area of interest, certainly for institutional investors. The challenge at the moment is they're still a relatively small part, even within the use of proceeds bonds. I think really what's needed there is, again, transparency and maybe more aggressive targets and metrics over what are the penalties if there is non-compliance by those SLB issuers, making the step up in the coupon rather than a few basis points, 50 basis points, or even over 1%. And also, when will they pay that penalty? Is it 3 years' time, 10 years' time? Trying to bring that closer and have regular reviews of those. Specifically around sort of policymakers, definitely increasing requirements around certainly like corporate disclosure, as we're seeing here in the UK around TCFD standards. And critical to Tony's point, making sure it's not just disclosing what you have emitted last year, but having those forward-looking metrics. Those are essential to be able to assess to what extent is a company that may be bad today, are they taking the steps to transition for the future so they can still attract that critical finance needed to facilitate that transition.
Okay, thank you, Rupert. And I also wanted to bring up a point we discussed earlier about aggregation. I think especially in emerging markets, we find that the demand is there, but because the size of the potential projects, the size of the issuances are so small, that the government should step in terms of how do we aggregate it and get it to a sizable point, level that it can tap into the capital markets. I think that's a key factor as well. So on that note, we were given instructions to be efficient with time, and we have been very efficient with time. So could I just open questions to the floor? Then, yes, please.
Hi. Hi, Prashant from CBI. My question is about green building certifications because I primarily work in that area. So because Rupert mentioned at the end about having a universal definition or a more generalized definition of what a green building is, my question's to Christina. What's the future of green building definitions, do you see? Because we're talking to a group of people from the US, and their idea of a green building was to incorporate water efficiency within the definition as well, and not just energy efficiency. There's other concepts, like, for example, the part of India where I am from, there's no concept of district heating, whereas that's very important in some other parts of the world. So how do you see the future of the definition? Do you see a proliferation, or do you see a sort of convergence to one definition? And maybe a side question to Rupert and the others as well, in terms of what's the investor preference when it comes to investing in green buildings? How general or how granular is the discussion when it comes to investing? Thank you.
Thank you so much. Okay, so I'm going to break it down for starting that it is a local, the buildings are, it's a non-tradable sector, right? It's local. And every geography has nuances in terms of definitions. However, the principles are one and the same around the world. So I guess from the World Green Building perspective and the collaboration of green building councils that have leading certifications, we have a commitment, and we have to deliver on it, on bringing clarity on what are the principles that are shared about those tools for the financial sector to understand better what's it about. Climate Bonds has got it, that collaboration is there, that let's say, simplification is there. However, you said it, India has priorities, Colombia has priorities, Britain has priorities. A green building delivers about people, it's not just about the asset class. So the entry about holistic sustainability is nuanced. However, that doesn't mean we can understand that we're talking about high-performing assets in terms of their whole life cycle, yeah, and what that means, that it's assets that deliver healthy spaces for people to thrive, but also, let's say, definitions on how they are overperforming over brown property that have, let's say, a different pathway. And it goes also to the transition in different geographies. One definition per sector will have different baselines around the world for every sector around economies, yeah, because it's different. But as we understand the pathways for the transition in different geographies, countries, or locally, and to different climate zones, then you will understand how do you compare what today is perceived as apple and oranges. It's one and the same, but there's a few set of principles that we have to get better as a movement from my side to explain to the financial community what is that ESG translation of what has been happening in those standards, and how can we scale up. We have the solutions to quickly bring more of that into the market.
Yeah, I think, Prashant, so I'd add regarding sort of granular detail around impact reporting. Simple answer, we just need more of everything. I think what we'll see, or what we need to see, is probably too much information being given, and then the industry will identify a common standard, and then they'll scale back the information that's needed, but also have a common standard and a frequency as well as to how that information is reported. But generally, I see clients querying around energy sourced, what proportion of that is from renewables, what's the estimated sort of maybe reduction on water or carbon emissions avoided, those kind of details particularly, and biodiversity impact as well. What's the assessment on biodiversity? I think that's going to be a critical, increasing part of sort of the climate, environmental related investment objectives for the investors that we interact with, certainly.
Thank you. We have a question from over there.
I'm very glad that Christina Gamboa brought up the subject of buildings and demand, because this is part of the great challenges we're going to face. So curtailing demand is equally important, from generating electricity from renewables and what have you. And today we have a lot of tools to enable buildings to lower their demand. Forget about net zero buildings. Lowering demand of energy in buildings can happen now. And I see that green bonds and the whole issuance of green bonds through banks has an important role to play in that a lot of buildings are through mortgages, banks are financing this. So what simpler way that banks to insist that new buildings or renovation of buildings can actually apply with the various low demand, energy demand criteria. So we have the solutions already, but they're not applied. In many countries where we have standards for low demand, energy demanding buildings, systematically they're not applied. And planning authorities do not care very much about insisting on buildings complying with the criteria. So we have a policy issue here and a regulation issue. Thank you.
Thank you very much. I think that's a very fair point. We may have the policies, but what about the enforcement of the policies? I think that's a key point. We have one question from over there.
It's getting there.
Valley Impact Asset Manager. A little bit different thinking, maybe. Our colleagues feel that there's enough policy, and there's good enough standards, and there's good enough reporting, and 2025 is 3 years away, and we've already invested billions of dollars in, for example, no critical metal energy storage that can scale up, no steel, no cement construction that's carbon negative, and now we need you guys to come in with the trillions to refinance our ABC. So my question is, how much policy and reporting and transparency is good enough? When is it good enough?
Ooh. Good one.
I mean, I'll just jump in. This is completely out of my comfort zone. I'm going to kick it right over to you. But I think the reality is that there is a, and I just think something about the Climate 100 plus, right? So you had 168 of the highest emitters in the world. There's a real, and I've never seen more client activism going on, which is creating its own standard. And again, disclosure, transparency, and the way that people think about deploying the capital that they're doing. So there is a market, what I think, force at hand that will ensure not just the policymakers and making disclosure requirements, which is happening, but also what is the standard of what we need to do too. And this could come back to the green investment in various energy efficiency through green bonds, because we have the global, well, you guys probably are familiar with this, but the ICMA Capital Markets Association green bond principles, which clearly outline there what's appropriate in regarding green bonds. So I think that there's a market push of policing, I guess, for a better word, of what is required for disclosure. I mean, from our standpoint, I actually met with our equity research team yesterday, and they don't think that there's enough disclosure. And what I mean by that is, there's a lot of high peripheral disclosure that's being done in a holding company, but really digging down into the subsidiaries and operating levels with regard to carbon footprint. That doesn't really exist yet. Again, full detail of the whole carbon network, scope 1, scope 2, and scope 3. And targets really there too. So I think there's more we can do, and I think it's going to be policy, governmental support, regulators, all the other constituents, coupled with market activism going on to make sure we get there.
Yeah, I'll chime in as well. I personally think that there isn't enough regulation out there, but that isn't an excuse to not do anything. And I think what regulation does is it can help those that take a lead, and it's great to hear that you are taking a lead in this, but it can also help to bring everybody along with you. And we're quite clearly not in a position where the economy is going in the right direction yet. So therefore, we do need policymakers and corporates and finance and civil society to all be working on this. So I think I can't give you this is the holy grail of policy, because policy will need to adapt and evolve as well. But we certainly need a lot more policy to get the data, to get the incentives right, to get the sticks right as well. And you could argue that the current energy security crisis is partly because we didn't get enough of the incentives right to have resiliency in our energy system. So it's not there yet, is my opinion. There needs to be a lot more. Mandatory disclosure is one of it, but incentives and sticks as well.
Yeah, and the policy signals really matter to bring along the ones that are not in the room today. And if we think next year is in the UNFCCC process, the global stocktake. So the pillar of the Paris Agreement is those nationally determined contributions, the climate action plans. And there's a recent analysis yesterday from WRI saying that the plans that are there are not aligned to half emissions by 2030. So the policies are not aligned to those, to that, are not ambitious enough. So that's why the leadership from the finance community, from having collaborations with sectors that can decarbonize, but we need to prioritize, like for example, that clarity, let's reduce demand in buildings. That will get policymakers more confident that they can continue to give them more ambitious regulations that are needed to activate others that are not acting. And I'm taking that language from the high-level climate champions.
If I could just add a bit of an example around lack of transparency. Equity investors have it pretty lucky. Coverage, take for example carbon emissions, is pretty good in your equity universe. Not so great, but still sufficient for fixed income investors to apply a thematic approach. But standard carbon intensity coverage in your global corporate universe is probably going to be around 90%, and a lot of that is still modeled and estimated by specialist data providers. So we want to see less modeling, more self-disclosures by companies, and yes, that data can then be cross-checked by all sorts of different sources, increasingly even like satellite technology, assessing to what extent a power station is actually switched on or not, and whether that aligns with what the company is disclosing. So another point is differences around the world. Different countries maybe have different standards around disclosure as well. So that's where you see poorer coverage. So yeah, fixed income, a little bit more complex. You've got a lot of private issuers, even in parts of Europe. Hard to assess the carbon emissions, but also to what extent is it scope 1, scope 2, scope 3. Name an example, Rabobank. They're invisible for the equity investors. Now they may be quite significant investors in the agriculture sector. Could we somehow quantify and assess that related carbon risk?
Thank you. Hi, my name is Nuno Briti-Cunha. I work for 8Versa. We're a sustainability consultancy. My question is to you, Rupert, on, you mentioned the step-up clauses for SLBs and linked instruments. I just wanted to hear a few more of your thoughts on what could be the solution to getting step-up clauses that are penal enough, or rewards that are strong enough to really incentivize the ambitiousness that we could potentially see with SLBs. So my worry is that SLBs are not ambitious enough, and we have a great mechanism to hold issuers accountable. Yet what I see in the market is that step-up clauses are marginal. They're not really penal in any way. So yeah, I'd be interested to hear your thoughts on what could be the solution. Is it a standard across sectors? Is it a sectoral approach? Be good to hear your thoughts.
Yeah, thank you. I think definitely standardization within sectors is key. So SLBs are a fairly sort of more newer part of your use of proceeds sort of investment opportunity set for investors. I think there just lacks confidence by investors at the moment to go into them in a big, meaningful way. Green bond market, it's pretty big, it's been established around for a while, it's pretty deep. So large investors who need that liquid exposure, they're an obvious area to invest in. SLBs fairly few in size. So I think as it grows and as it does become more standards, you will see greater commitments there by institutional investors wanting to push that capital into those segments. But standardization, again, transparency of what are the carrots and what are the sticks for those issues if they get it right or wrong needs to occur as well.
I mean, I'll just add a couple quick points there, because I've worked on a lot of the SLBs when really since its infancy and starting out. Enel going back well before Novartis and others then took off, and it obviously became a big market. It's about 10% of the overall market. It's last year it was about 100 billion roughly globally of SLB issuance. The key issue was, I think, that in a zero rate environment, which we existed in, 25 basis points seemed like it was okay. And that was number one. Number two, in which this then it got adopted every sector, and that could be IG, so investment grade, or high yield that's trading at multiple 100 basis points over whatever the benchmark is. So clearly there's a gap there. Number two is, with the selection of more KPIs. So we have, obviously carbon footprint KPIs, so intensity, absolute metrics, diversity or governance, and the splitting of that 25 into 3 parts or in 2 parts obviously dilutes it further. So I think what we've been doing as a bank is saying, okay, listen, we need to have an appropriate step up. It needs to be somewhere in the middle of the bond, so it's not just kicking the last 1 or 2 coupon payments, which is actually very negligible from present value standpoint. Have it be meaningful, have it be generally adopted across your portfolio, not just a one-off deal. So if you're just a $50 billion, there's plenty of, call it institutions that have $50 billion worth of financing, in their portfolio. Have it be adopted. They're going to continue to do it. It's not just one-off. And then the last thing I'd say is, making sure that, maybe instead of 1, 2, or 3 KPIs being hit for 10 basis points each, you have to hit all of them or it steps up. So there's a lot of discussions there that are happening. It's just a little bit of a push and a pull from the investor side of what they want to see with regard to that stick, and then what the issuers are willing to do, understanding that a lot of these KPIs are also retroactive, i.e. if you come out with more aggressive KPIs, a lot of these are retroactive and then will impact the rest of your portfolio. So there's a little bit of a balance, and because it's such a nascent new market, I do expect that there's going to be more, call it, rethinking of what is appropriate, particularly in a higher rate environment, which we're going quickly into.
Hi, thanks. Just a quick question, and maybe Rupert, to you because you're on the buy side, and I know maybe a little bit outside of your lane, but I was reading a research report earlier this week, and on the equity side, ESG funds have underperformed the MSCI All World Index by about 600 basis points over the last trailing 12 months. That same research report, and I'm just looking at my notes, shows exposure of ESG funds to oil and gas, even since April, has gone up. Same for mining, same for kind of oil and gas equipment. And I guess I'm just wondering, we've come out of a world where, you could stick a fork in the ground and money came out, right? Money was free, everything was rallying, equity markets, credit markets hitting new highs seemingly every single day. IG credit in the U.S. is down 20% year to date on a total return basis. Yes, a lot of that's about rates. But how much of this becomes about returns at the end? And we've seen a lot of inflows into ESG-related funds, both on the equity and credit side. And if this underperformance continues, is that money at a risk of then flowing back out of these funds?
Good question. Thank you. No, I think is the short answer. Certainly with European investors, the ESG objectives of their mandates are getting to a stage where they're almost outweighing the sort of risk-return performance aspect of it. Those are seen as sort of the key driver of where they put their money. I think it's very important that investors also don't have a sector approach when they're looking to identify where the risks are and where the opportunities are. You want to be getting the specific data, using multiple different data sources if possible, given that there is often different perspectives, different views, different ways of weighing up a score of an individual company, to identify exactly how that company is not just performing now, but also what's its trajectory. And supporting that stewardship is obviously key, engaging with those companies, those very bad companies today, to make them aware of how potentially they are at risk of seeing investors divest from those sectors, but also maybe how they could attract those investments if they take the necessary steps and really improve their transparency and goals for carbon reduction, certainly. Does that answer your question?
Lina.
Hi, I'm Vivian Tew from Global Law firm Dentons. I hope I can take this opportunity of the expert panel across sector to ask the question. We heard about policy and regulations and the importance of that, and also policy signal. Just wonder if I can get your thoughts on the role of governments in leading by example in procurement or in sovereign investments, and especially like GFAN's in the back of COP26, and we're looking at COP27 ahead. What can private sector do more of in terms of engaging with government as well? Thank you.
Yeah.
So actually, in the framework that we are going to be publishing on the 1st of November on what a financial institution net zero transition plan should include, it includes how do you engage with policymakers. That's the same in the real economy as well. So corporates also expect to say how are you engaging to support your net zero plans. So that's the first thing. Yes, definitely should be. The second thing is, yes, I think private sector has been leading the way. But they're getting to the point where they need more support because we're not going fast enough in the transition. And obviously, the energy trilemma of security, affordability, and decarbonisation is sort of manifesting that at the moment. So I think the message is we need more incentives, we need more of the sort of mandatory disclosure so we get the data, and keep that long-term policy going and the ambition to achieve it. Yeah, absolutely. Just, and government can also lead the way on procurement, as you said, and I think we touched upon it. When they're doing infrastructure, funding infrastructure projects, purchase green steel. So we want to actually purchase green steel in that infrastructure. We want to purchase, create hubs that can do hydrogen, renewable energy to support green steel, sustainable aviation fuel, green cement, other things as well. So procurement can lead the way there.
No, I'd just say, I was in a panel with a group of large integrated oil and gas companies. We had actually a government, this is in the U.S., government representative there listening in, which is the first time I've actually had that, because obviously on the back of the IRA policy that we talked a lot about, is how the government can think about putting in place the appropriate incentives in ensuring that the capital flows and deployment is done in the right way. But if you don't have, and not everybody's in the same room, it's never going to work, right? So you need to figure that out. And the other bit is, which I found fascinating, is really having, with the spend, real governmental 20-year plus offtake to ensure that the viability of the project and the infrastructure spend up front is going to be break even or positive. Obviously, there's positive returns because, again, we talk about this chicken and egg, and it's really the government taking the leap, whether it's building, construction, again, it could be anything. And then that needs to be in place. And then clearly over time, the more first leaders, we'll call it, corporates and government doing that, then we'll again drive the speed at which we need to move at. And I think that'll be quite helpful.
And if I may, whole life cycle thinking from government procurement, because to your point, if there's not a vision of assets that are going to be built today are going to be around at least 50, 80 years, and we design them with not the climate of the future, but past standards, then the problem will be that possibly governments will be thinking, if they don't think whole life cycle, they will be putting out procurement asks that are just thinking on the short term, and then you got very cost-effective projects, yes, but they're not thinking on how they're going to perform over the life cycle, and then that maybe inhibits procuring better, best-in-class solutions to achieve decarbonization, and that's a shift also in government policy. How do they procure longer-term thinking than just short-term cost, demanding environmental product declarations, transparency for everything they purchase? It could be their choice.
Great. On that note, I'd like to thank my panelists. It's been great moderating. I haven't done anything. You've done all the work for me. Thank you very much. And thank you to the audience for listening to us. Thank you very much.
Thank you.
Quick note. Tony and I have been talking about this idea of a offtake agreements coalition or project. As he said, offtake agreements drive cost reductions. Now, wouldn't that be cool if we got all the major airlines in the world around a Synfuels offtake agreement, governments procuring, and of course with the World Green Building Council, our real estate trusts offtake agreement. There's opportunity here. Watch this space. Steel, property, cement, Synfuels, etc. 2, we are launching in the next few seconds, if you want to watch the screen, the Climate Change Investment Framework Report, which we've done with the Asian Infrastructure Investment Bank and Amundi. There'll be a recorded interview with Calvin Quick, one of our teams, Krista and Timothy Jolin, playing in the background. If you want to bring your lunch in here and watch it, just reasonably short, so you can hear about it. But in the meantime, it's online. So another project which is essentially looking at measuring company performance in Asia. Quite important to today's panel, right? It's Asian focus. And lastly, COVID is still around. We have had a modest in-person audience. We have a big online audience. Of course, watch social distancing, be careful. We still have to be ensuring that we don't spread in one of these big events, which is why it's reasonably spacious here today. So just be aware. And then lastly, enjoy your lunch. There's lunch outside, and come back in a little while for the next exciting installment of this. We'll be dragging you in towards the end of lunch. Good luck with your networking. Remember, deal flow, please.